Hello, Colorado, and welcome to Nolan Financial Radio. I'm Chris McKinney, and today we're going to spend the next half hour or so talking about something that is sitting in the back of a lot of minds right now, your 401k. Maybe you checked the balance last month and it was lower than you expected. Maybe you looked at it a statement and you thought, wait, where did that money go? Maybe you have been diligent, saving year after year, and starting to wonder whether it's actually going to be enough. You're not alone. And your concern is not irrational. The first quarter of 2026 was a rough one for retirement savers. We have hard numbers from Fidelity Investments published just in the last 2 weeks that tell us exactly what happened. And more importantly, what it means for you. Here's what I want to do today. I want to talk to you about what you should realistically expect from your 401k. Not the glossy brochure version, but the honest data backed version. We're going to talk about returns. We're going to talk about risk. We're going to talk about what the research says about how people are actually behaving with their retirement accounts right now, and whether those behaviors are helping them or hurting them. So, and we are also going to talk about what a smart, realistic 401k strategy looks like in 2026, because the rules of the game have shifted and the strategies that worked 10 years ago may not be the right ones anymore. I want to be your guide through this, not to scare you, but to equip you, because the people who understand what their 401k is supposed to do and have a plan built around that understanding are the ones who cross the retirement finish line with confidence. Let's get started. So let me start with the freshest data I have. On May 28th of this year, literally 2 weeks ago, Fidelity Investment released their Q1 2026 retirement analysis. So Fidelity is the largest 401k provider in the country. They manage accounts for more than 54 million retirement savers. When they report, it matters. So here's what they found. The average 401k balance at the end of the first quarter of 2026 fell 4%, dropping from a record high of 146,400 at the end of 2025, down to 141,000. That's kind of surprising, right? So the average IRA balance dropped the same amount, 4%, landing at 131,380. 4%. That sounds manageable, right? And in isolation, it is. But here's the context that matters. That drop was not a gradual slide. It happened fast and is driven by a specific event. On February 28th, the United States and Israeli forces attacked Iran. In the days that followed, the S&P 500 lost 5.1% in March alone. Its worst monthly performance since 2022. The Dow dropped 5.4%. The NASDAQ declined 4.8%. So now, markets have since recovered. As of early June, the Dow is up roughly 5.3% year to date. The S&P 500 is up nearly 10%. The NASDAQ has gained 14.8%. So for many people, those first quarter losses have been erased and then some. But here's what I want you to understand. That whipsaw, that rapid drop in recovery, is the new normal, right? Your 401k's ability to weather it depends on about almost entirely on one thing: how it is invested. So the Fidelity data, something that they kind of went through, and I was going to flag this for you because it's the warning that I don't hear really enough. More than 6% of all 401ks savers have 100% of their money in equity. All stocks, no bonds, no cash, no cushion. Now, is that the right thing? I don't know. Maybe it is for them. Because what makes more money? Stocks, bonds, cash, or cushion? So here's the number that concerns me a lot too, is 7% of savers in the 50s have all their savings in stock holdings. Well, maybe that's the right thing. Maybe it's not, but something to think about. So people in their 50s, a decade or less in retirement, all stocks. So can you manage those upswings and downswings, right? So understand how this happens. The stock market has a spectacular run. The S&P 500 gained nearly 17% in 2025. International equities returned 32%. When the market is delivering returns like that, it's very easy to forget that gravity still exists. But here's the math problem. If you are 55 years old and your 401k has $500,000 in it, a 10% market correction takes $50,000 off your balance. You have 10 years to recover it. And that is very different from being 35 with $100,000 in the account and 25 years to recover. So the time horizon changes everything. So that's what we have to look at. That's the key to it. Now, if you're 50 and you're not planning to retire till 65, that's 15 years. So maybe that does work. But if it's 5 years, maybe 10 years, maybe it's not so good. So Fidelity's own guidance is pretty clear. Investors planning to retire between 65 and 67 should be gradually trimming their exposure to stocks and adding more conservative holdings, bonds, stable value funds as retirement approaches. Not eliminating equities, but trimming them, right sizing the risk for where you actually are in life. So now Fidelity says that because that's their what they have to show people is they have bond funds, they have value funds, they have different retirement approaches. We have some different things here at Nolan Financial Partners, some alternate accounts that are totally not tied to the market. So there's other ways to do it. So if your 401k allocation has not been reviewed since the last year, especially if it has not been reviewed since the market started swinging, that's step one. But maybe it is you've got too much money in bonds. Maybe you're too conservative too early. So these are things that must be looked at. You know, if you're in one of the target date funds, that stuff is automatically done for you. Now, is it in line with what you actually want? Do you know how much money is in equities versus bonds versus cash style holdings or value holdings in the target date fund you have? So it's something that you need to review and need to look at. So one more piece of context before we go on. Despite the quarterly dip, here's the longer view. The average 401k balance is still up 11% compared to the same time last year. The average 403b is up 13%. The average IRA is up 7% year over year. So the direction is right. The trajectory is positive. What we need to make sure is that your specific allocation is positioned where you think it should be. It's aligned with your strategies, your goals, what you expect from your 401k. It's not something you just let happen, right? So make sure that you're not just a market shock away from a loss that you can't really absorb. You know, what are you going to do about that, right? So you've been listening, and maybe some of those numbers hit home. Your 401k balance dipped this quarter. Markets have been volatile. You're wondering, is my plan actually built for this? That is exactly the conversation I want to have with you. At Nolan Financial Partners, we sit down with real people right here in Colorado Springs and help them understand what their 401k is really doing for them and what it should be doing, right? So call us today for a complimentary appointment. No cost, no pressure, no sales pitch, just clarity. That's 719-210-4242. Visit us at nolanfinancialpartners.com. Give us a call and set up that complimentary consultation, 719-210-4242. Okay, welcome back to the show. I'm Chris McKinney. This is Nolan Financial Radio. We're talking today about your 401k. Specifically, what should you really expect? Because I think a lot of people carry around vague assumptions about it. They don't really know. They just went with whatever the person they met with at their new company that said, here's the 401ks, here's what everybody's picking. And so you just picked it. So are you really making a financial decision when you select your 401k investment strategies, right? So let me give you a few numbers we can kind of anchor out here. So a 401k invested entirely in broad U.S. stock index funds has historically earned roughly 9 to 10% per year before inflation over multi-decade periods. That's a very long run average. It's a real number and it reflects genuine wealth building power. I don't think there's anybody that's going to that can argue that the best way over a long period to make money on money is the U.S. stock, uh, the U.S. stocks, right? So without hitting something magnificent like some specific stock, a broad stock fund can help you make money, right? Now, if you invest specifically in stocks and pick ones, and if you picked Tesla 20 years ago and you bought Bitcoin in 2002 and maybe you don't have to work anymore. But that's not what we're talking about. We're talking about how 401ks are invested and how most people use those. So very few people are 100% stocks. And should they be, right? I don't know. Let's look at who you are, right? So a more common allocation is that balanced portfolio, those target date funds that are like 60% stock and 40% bonds, depending on how close you are to that target date. So those balanced portfolios have returned 7 to 8% annually. So that's not as good as the 9 to 10. So let's get that out of the way. You're right. It's not as good. But what does that mean in practice? If you're investing $10,000 per year in a 401k, earning a steady 7% return over 30 years with a 1% annual fee, that account grows to approximately $827,000 before taxes. So that's $10,000 a year for 30 years, $827,000 before taxes. If the market performs like the S&P 500 did from 95 to 2024, that same contribution strategy will produce over $1 million. If the market has a rough final decade, like 79 to 2008, which includes the dot-com crash, you might end up closer to 708,000. Okay. So the range is pretty wide. So that's the honest truth. And that's exactly why having a plan, not just a balance, matters so much. So a plan. So that's what we encourage. Having a plan, understanding your strategies, understanding your goals and your targets. Here's something that most 401k participants have never calculated: the cost of fees. So the SEC has published research on this, and the numbers are pretty striking. A 1% annual fee on a 100,000 account over 20 years does not cost you $1,000 a year. It costs you significantly more because every dollar paid in fees is a dollar that is no longer compounding, right? So that $100,000 account, whatever it goes up by, then it has that 1% fee that comes down. Say if it's just 1% of the 100,000, so that's $1,000, and then now the next year you don't have that $1,000 working for you. So a difference of just a half a percentage point in annual fees, say 0.5 versus 1%, can translate to tens of thousands of dollars over 30-year retirement. This is real money. Most investors have no idea what they're paying. Now I can tell you that what you pay matters, right? But there are funds out there that charge 10%, 20%, and they're hard to get into. Maybe you can't get into them; they're closed. And people paid these big fees because they had big returns. So some of the cost of things, is the cost worth it? So that's what you have to decide. If I go over here and I can get 10% and I pay 1%, is that better than making 7% if I only pay half a point or half a percent? So it's something, what's the value there? So the expense ratios are important to know what they are. Do you know what the expense ratio is on the funds inside your 401k? Is that the complete answer for how much your cost for that money being in there is, does the 401 kick out some administrative fees? Are there fees to, the person that administrates the funds, the fees to the custodians of the funds, the fees to the people that move the money, and then just maybe a fee inside the individual fund. So there's lots of places where these fees start to show up. So we should have this information in the fund documentation, and we can always help you understand what you're paying and whether there are a lower cost inside your plan. We are very transparent here at Nolan Financial Partners with things that we do so that you know exactly how much you're paying for everything. And so we're very upfront about it, and we just show you okay, you have this much money. Here's what you paid for the management fee, for our fee, for everything that goes into it, right? So, okay, so now we're going to talk about savings rate. So here's the truth that sometimes surprises people. Over your working lifetime, your savings rate has a bigger impact on your retirement outcome than your investment return does. Because a dollar is a dollar. The percentage on a dollar, yes, that's maybe you made 10%, that's only 10 cents. So every dollar is a lot more than 10 cents. Think about that. So most investors obsess over performance. They move money around trying to chase best returns. But the single most powerful variable in the equation is how much you're putting in every month, every paycheck. Fidelity's Q1 2026 data brought good news here. The total savings rate, combined both employee and employer contributions, reached 14.4% in the first quarter of 2026. That is a record high. Fidelity's suggested target is 15%. We're closing in on it. That's a really good news. People are starting to understand saving. IRA contribution activity also hit records in Q1 2026. The number of people contributing to IRAs rose 28% year over year. Contributions themselves were up 29%. That's a good picture for Americans, right? So despite all the noise, despite all the volatility, despite the geopolitical tension, continue to build for the future. We're continuing to create more wealth for ourselves so that we can have money to live on when we're not working anymore. So let me put some personalized numbers into this. In 2026, if you're under 50, you can contribute up to $24,500 to your 401k. If you're over 50, that's limit is $32,500. That extra $8,000 is what's called a catch-up contribution. And if you're between the age 60 and 63, you can even do more. Under Secure 2.0 Act, your catch-up limit is $11,250, bringing your total possible contribution to your 401k to $34,750 for 2026. So are you taking full advantage of that? If not, why not? And because this is, excuse me, this is real money going into a tax-advantaged account, growing year after year, working for your future. If budget is the constraint, let's talk about that. There may be ways to find room. Here's the number I want you to sit with. Fidelity just reported that nearly 1 in 5 401k participants, 19.2%, currently has an outstanding loan against their retirement account. And hardship withdrawals rose to 2.5% in the first quarter of 2026. What's going on? Those are people just like you and me, people under financial pressure, are reaching into tomorrow to pay for today. Every dollar pulled out early is a dollar that will not compound over the next 10 to 15 years. I understand interest rates may be causing some of this, right? If you are feeling that kind of pressure, I want to talk to you. There may be smarter options. Call Nolan Financial Partners and let us put a real plan in front of you free of charge. So call us 719-210-4242. Your first appointment is always free. Check us out at nolanfinancialpartners.com. Okay, you're listening to Nolan Financial Radio. We've been talking about what to expect from your 401k, and I want to spend a few minutes on some warning signals that The Fidelity data surfaced because not everything in the report was encouraging. Warning sign number one, the loan problem. The percentage of workers with outstanding 401k loans rose 19.2% by the end of the first quarter of 2026. Nearly 1 in 5 workers have borrowed against their own retirement account. Now, 401k loans are not automatically catastrophic. They can be a legitimate tool in a genuine financial emergency, but they carry real risk. If you leave your job, voluntary or not, the outstanding balance typically becomes due quickly. If you cannot repay it, it is treated as a distribution, meaning taxes. And if you're under 59 and a half, a 10% early withdrawal penalty. So, more fundamentally, every single dollar sitting in a loan balance is a dollar not invested. It's not compounding, it's not growing. It is sitting on the sidelines at the worst possible time, which is usually during a period of financial stress, often when the markets are quite volatile. If you have an outstanding 401k loan right now, I'm not judging you, okay? There's no judgment. There's no morality of police in my office. I'm asking you to have a plan for it. When will it be paid off? What is the plan if you change jobs before then? Have you talked to an advisor about whether there is a smarter alternative, right? So, hardship withdrawals, the kind where you pull your money out of your 401k because you genuinely have no other option, rose to 2.5% in the first quarter. That sounds small, but it represents a meaningful increase as a sign of household financial strain that's running deeper than the headlines suggest. So Douglas Boneparth, a financial advisor in New York and founder of Bonafide Wealth, put it plainly, ongoing inflation and elevated living costs are squeezing consumers. People are reaching into tomorrow to pay for it today. Hardship withdrawal is expensive. You pay income taxes on the amount you take out. And if you are under 50 and a half, you pay that 10% penalty. If you pull 20,000 out in a year when you are 20 in the 22% bracket, that might net you $13,000 or $14,000 after taxes and penalties. And you permanently remove $20,000 from retirement accounts compounding trajectory. So what is the alternative? That depends entirely on your situation. For some people, it's a HELOC on a paid up home, right? So maybe it's a personal loan. Maybe it's restructuring your spending plan. There is rarely a perfect answer here, but there's almost always a better answer than a hardship withdrawal. And the only way to find it is to talk with someone who can see your full financial picture. Okay. We touched on this a little earlier, but I want to come back to this equity overexposure in near retirement, right? The trade ideas, because this trade ideas research published this week frames it that it lands really hard, right? So today, the S&P 500 NASDAQ can swing so violently that the average retirement balances can shift $10,000 to $50,000 in a single week. Geopolitical uncertainty, tariff volatility, inflation, AI-driven market disruption. These forces have fundamentally changed the speed of market movement. The old advice, just hold, stay the course, is broadly true for long-term investors. But the closer you are to retirement, the less runway you have to recover from major sequence of return shock. A 30% drop in the market in the first 2 years of retirement when you're drawing down your account can permanently impair your income for decades. This is called the sequence of returns risk, and it's the most underappreciated threat in retirement planning. A portfolio that earns an average of 7% per year can still fail if it loses 30% in year one. The math is brutal, and math doesn't care that your long run average looks fine, right? Because the sequence of returns makes that a big problem. Solution's not a panic, it's positioning. It makes making sure your 401k is in the right place for you in your life with enough stability to protect you from that early retirement shock. Now, once you get full control of that 401k and it's not with the company, maybe there's some other things you can do to create money that won't be susceptible to those market drops so you don't have those big hits. So we have been talking about asset allocation. So whether your 401k is invested in a way that actually matches where you are in life, the research is clear. Too many people in their 50s and 60s are carrying a lot of equity risk, right? A lot more than they realize. So a market swing of 10% can be a $50,000 hit to a $500,000 account. And the closer you are to retirement, the less time you have to recover it. So we specialize in helping people in and near retirement right size their risk so that they know what the risk is, how much they want to be in risky market. Maybe you do something that's a little bit more managed, protect what you have built, sleep at night. Let us take a look at what you have. The conversation is completely free. Call us at 719-210-4242. That's 719-210-4242. Is your 401k allocated for where you are today? Let's find out. So, okay, we looked at the risks, we looked at the warning signs. Want to spend a few minutes on what research about behavior and strategies are actually working. So, the people who are winning in their 401ks are doing something specific. Let me tell you what that is. They stay the course. Only a fraction of participants made any change to asset allocation, even as markets swung hard. So discipline is important. Knowing what you do, keep those automatic contributions going. That dollar cost averaging is a real thing in volatile markets that can help you and do more for you. It's better than being an active trader, having that consistent contribution going in. So you're always taking advantage when the market's being volatile, goes down, you buy a little bit more, right? So that's something that's good. Okay. Contribute more after 50. So these contribution limits are a lot higher. You've got the catch-up window retirement after 50, and then between 60 and 63, you can actually do about $3,250 more than you can when you're just with over 50. So make sure that you're getting that extra catch-up into that 401k. So keep using that volatility as an opportunity. So contributions are up year after year. So this is kind of goes into one is when the market drops, the shares you buy through contributions are cheaper. So keep doing that. Build an emergency fund outside your 401k. Make sure you have some money that you can rely on. That's 3 to 6 months of expenses. Okay, in retirement, we talk about expenses, not about 3 to 6 months of your salary, right? So we've covered a lot of ground today. Your 401k is not a lottery ticket. It's not a set it and forget it magic count. It's a tool. And like any other tool, it delivers the best results when you know how to use it correctly. So make sure that you understand where your risk is, what your strategy is. Make sure your 401k is working hard for you. Make sure it's working smart. I'm Chris McKinney. Thank you for listening to Nolan Financial Radio. We'll be back next week. Until then, take care of yourself and take care of your future. Give us a call at 719-210-4242 to set up that complimentary consultation, and we'll talk to you soon.